In 2025, US households face a stark affordability gap. Housing costs have risen 40% since 2020. Median incomes grew just 15% in the same period. Layoffs, fueled by AI automation, hit 2.5 million jobs last year alone, per Labor Department data. Rent and groceries consume 55% of take-home pay for the bottom 40% of earners. This leaves little buffer. Enter the government's three-step housing plan, announced in late 2024. Step 1. Expand FHA loans. Step 2. Subsidize down payments. Step 3. Introduce 50-year mortgages to stretch payments over half a century. The pitch is to make homeownership accessible by slashing monthly bills. Yet this fix carries hidden risks. Without grasping the mechanics, borrowers could lock in decades of overpayment. This analysis aims to equip you with facts. The goal is not to enrich your lender, but to grow your own net worth. At its core, the 50-year mortgage trades short-term relief for long-term extraction. Monthly payments drop, sure, but total interest balloons. This funnels wealth from your pocket to the banks. For most, this is not a ladder up, it is a slow drain. We will unpack why, starting with the numbers. Consider a typical scenario. It is a $500,000 home in a mid-tier market like Phoenix or Atlanta. You put 20% down. That is $100,000 from savings or equity. This leaves a $400,000 loan at today's average rate of 6.5%, fixed for the term. Assumptions hold steady. No prepayments, no rate changes. Closing costs at 2% of the loan. Now compare a standard 30-year mortgage against the proposed 50-year version. For the 30-year mortgage, the monthly payment for principal and interest is $2,528. Total interest paid over the term is $410,000. The total cost of the home, including principal and interest, comes to $910,000. For the 50-year mortgage, the monthly payment drops to $2,275. This saves $253 per month, or $3,036 a year. But total interest paid rises to $875,000. The total cost of the home balloons to $1,375,000. The difference is stark. You pay $465,000 more in interest. That is 113% higher than the 30-year option. The overall cost increases by 51%. Sources for rates and amortization include Freddie Mac, with 6.5% as of the third quarter of 2025. These figures come from standard Excel payment formulas. Note that these exclude taxes, insurance, or maintenance. Those add 1 to 2% annually to outlays. Actuals could vary by 5 to 10% based on credit score or local fees. The monthly dip from $2,528 to $2,275 feels like breathing room. Over 30 years, that saves $91,000 in payments. But flip the lens to lifetime cost. The 50-year term inflates interest by $465,000. It pushes the home's effective price from $910,000 to $1.375 million. That is not savings, it is a premium. Why the disparity? Time works for the lender. Each extra year compounds unpaid principal. This accrues interest on interest. In the 30-year case, you own the home outright by age 55 if buying at 25. In the 50-year, you are still paying at 75. Here, 60% of your lifetime earnings go to interest, versus 45% in the shorter term. Banks do not build equity, they harvest it. This is not abstract. In 2024, U.S. mortgage debt hit $12.5 trillion, per the New York Fed. Interest payments alone totaled $500 billion yearly. A shift to longer terms could add $1 trillion in aggregate interest over a decade. This assumes 20% adoption. Borrowers gain margin. Institutions gain margins. Mortgages are not simple IOUs. They are amortized loans. These are structured to repay principal and interest in fixed installments over time. Think of it as a conveyor belt. Early payments mostly grease the bank's wheels with interest. Principal repayment crawls forward. Take that, $2,528 monthly on the 30-year loan. In year one, 85% or $25,700 goes to interest. Just $7,000 chips at principal. By year 10, the split evens at 50 to 50. Only after 23 years does principal dominate. This front-loading ensures the lender recoups risk up front. It stems from the design in the 1934 National Housing Act. The misconception bites hard. Borrowers assume even splits, half to the house, half to the bank. Reality, in month one of a $400,000 loan at 6.5%, $2,167 is interest. That is your full payment minus $361 principal. That is 86% to the lender. Straight cash flow. Over 5 years, you have paid $151,000 total, but principal drops the loan by just $25,000. The rest? Bank profit. Extend to 50 years, and the trap deepens. Payments fall to $2,275, but the front load intensifies relatively. Year 1 interest, $2,125, or 93% of the bill. Only $248 to principal. By year 20, principal still hovers at 40% of payments, versus 60% in the 30-year. The extra 2 decades mean interest accrues on a larger average balance. That is $300,000 unpaid midway through a 50-year, versus $150,000 in a 30-year. Simple metaphor. It is like renting from yourself, but the landlord takes the lion's share first. Data backs it. Consumer Financial Protection Bureau reports show 70% of early mortgage payments fund interest. This holds regardless of term. Lengthen the lease, and the landlord's cut swells 113%. As our example shows, variations exist. Refinancing or extra payments could shave 10 to 20%, but only 15% of borrowers do so consistently per 2023 surveys. The result? Equity builds like molasses. After 12 years on a 50-year mortgage, you have paid $327,000 total, yet you own just 12% of the home. That is $48,000 equity. On 30 years, $362,000 paid, 28% owned. That is $112,000. The longer term starves your balance sheet, even as monthly stress eases. Proponents counter. Americans do not hold homes forever. Median tenure is 12 years. Per National Association of Realtors 2024 data, down from 14 inches 2010. Sell early. Pocket the $253 monthly savings. Invest in the S&P 500. At 7% historical annual returns, post-inflation, that $3,036 yearly compounds to $52,000 after 12 years. This outpaces the $30,000 extra interest accrued in that window. On paper, it clicks. A 50-year borrower saves $36,000 in payments over 12 years, invest at 7%. Nets $10,000 above the interest delta. Shift to a 30-year, and you forego that leverage. But paper ignores behavior. Only 25% of U.S. households invest consistently in stocks. Per Gallup 2025 polling, the rest park savings in 0.5% bank accounts, or spend on impulse. Reality skews grimmer. Homeownership devours surplus. Beyond the mortgage, add property taxes, that is 1.1% of value annually, or $5,500 a year here. Insurance, $2,000. Maintenance, 1% of value, $5,000. Upgrades, $10,000 every 5 years. Total extras, $15,000 yearly. Per American Housing Survey, for 70% of owners, those living paycheck to paycheck, as Federal Reserve data flags, there is no savings to invest. The $253 flows to HVAC repairs, not Vanguard funds. Regret compounds it. A 2024 Redfin survey found 52% of buyers from 2019 to 2023 rue the purchase, citing 25% unexpected costs. Eating budgets. Houses morph from assets to anchors. 40% of owners tap home equity lines for emergencies. Per TransUnion. Restarting the interest clock. In volatile markets, home values flatlined 2% in 2024 amid 7% inflation. Selling nets zero gain after fees, 6% commissions. The opposition holds if you are disciplined. A high earner with automated investments, but for the median buyer, $75,000 household income per census, it is a mirage. Equity traps 80% in place, per Urban Institute studies, turning ownership into perpetual tenancy. Consumer debt thrives on optics. A lower car payment or mortgage bill signals affordability, but total outlay tells the tale. In our case, the 50-year option costs 51% more overall. This echoes auto loans where 72-month terms add 20% interest versus 48 months. Per Edmunds data, the rule: scrutinize lifetime math, not monthly mirages. Exceptions abound. Medical windfalls or inheritance could refinance early, but plan for the baseline, not the outlier. Wealth accrues asymmetrically. Banks lend at 6.5%, earn 4% spreads on deposits, deploy profits into 8% yielding bonds. You? Chasing 7% returns while servicing debt. Flip the script. Prioritize self-funding. Treat the home as shelter, not speculation. U.S. homes returned 4.2% annually since 2000. Lagging S&Ps 7.8%. Per Case Shiller and Vanguard indices, reframe ownership as liability. Cap housing at 25% of income. Per Financial Planners 28/36 rule. Divert the rest, $500 monthly here, to index funds or Roth IRAs. Compound at 7% over 30 years. $500 a month grows to $550,000. That is not riches overnight. It is systematic transfer from lender to ledger. Forecast ahead, with rates hovering 6 to 7% through 2027, per IMF projections, and AI displacing 10% of white-collar jobs by 2030. Affordability erodes further. Longer mortgages may proliferate. Canada's already at 40 years average, but adoption risks a debt overhang, echoing 2008 seconds $10 trillion bubble. Borrowers who calculate totals, invest surpluses, and hold tenures under 10 years fare best. The rest? A lifetime feeding the system. Measure twice, commit once.